let's focus full tilt on the big developing story today. Due to continued redemption pressure and lack of liquidity in the debt markets, add to it the lack of subscriptions coming in, and amidst the lockdown, Franklin Templeton Mutual Fund last evening announced winding up of 6 of their debt schemes. What does this mean for the market? Why did it happen only at Franklin Templeton? And what happens now? We have the board of AMFI and the chairman joining in now. Nilesh Shah, the chairman of AMFI, also MD and CEO of Kotak Mutual Fund. We also have 4 AMFI board members: Nimesh Shah of ICICI Pru MF, Milind Barve of HDFC Mutual Fund, A. Balasubramaniam of Aditya Birla Sun Life Mutual Fund, also all former chairman of AMFI, also Ashwini Bhatia, MD and CEO of SBI Mutual Fund, a board member at AMFI, and Lata Venkatesh also joins in. Gentlemen, good morning to all of you, and Lata, to you as well. The first question that investors and I guess everybody wants to know is what really happened. So Nilesh, if I can come to you first, is if you can explain the anatomy of how and why a scheme is wound down, what happened at Franklin, and what does it mean for investors?
So Meera, I think it will be fair and appropriate for Franklin Temple to answer what circumstances forced them to take this decision. I, on behalf of Association of Mutual Funds in India, would like to reassure investors that all our debt funds, whether they are credit risk fund or non-credit risk fund, have reasonably good credit quality, they have adequate liquidity, and they are geared to meet normal day-to-day operations. Obviously, these are challenging times, but lots of steps have been taken by SEBI, RBI to ensure that market functions normally. Today, banking system liquidity is more than 7 lakh crore. On 27th March, RBI cut interest rates and introduced TLTRO. They have pumped liquidity in banking system to ensure that market yields remain under check. They have done Operation Twist to ensure that yield curve remains under shape. And all these steps have ensured that yields have fallen, markets are liquid, and for good credit quality portfolios, there is no dearth of liquidity. And this is allowing most mutual funds to run their business normally, even in this challenging time. On behalf of AMFI, I would like to reassure all debt investors that they should not deviate from their financial plan. They should consult their financial advisor and look at credit quality, liquidity profile, and investment process of mutual funds to get reassurance that their monies are safe with us.
No, Nilesh, I take your point that, it could be a AMC specific issue in this case. But, you can't tell every other investor right now that, not to panic. Therefore, can you tell us what, if there are any steps that you all are taking? I mean, will any fund sort of look at, stopping redemptions right now? Could the industry, sort of be forced to take any special steps right now? Has that been discussed? Is that planned? I mean, how can we assure investors beyond just, the obvious words?
Very fair question, Sumaira. We have discussion at the board level of AMFI and also at the member level of AMFI. While we are collecting data, most of the mutual funds have told and confirmed that they don't have any borrowing. As you are aware, all mutual funds are allowed to borrow up to 20% of their AUM for meeting redemption and dividend repayment. There was a borrowing in the month of March, but courtesy the steps taken by RBI on 27th March onwards, most mutual funds have repaid their borrowings. Absence of borrowing across most mutual funds suggests that our funds are liquid, they are managed in normal day-to-day manner, like we had managed it day before yesterday, today and tomorrow. The absence of borrowing itself should reassure investors that most of the mutual funds are in a good shape and their monies are safe. They don't have to worry about liquidity. They don't have to worry about such steps being taken by any other mutual fund. obviously, we will present more data to reassure investors. The second, I will recommend people to look at our fact sheet across industry. Majority of our AUM is in AAA rated treasury bills, government securities. These are absolutely liquid. Markets are functioning today without any trouble, courtesy all the steps taken by SEBI and RBI. So look at credit quality, look at liquidity profile, look at our borrowing numbers. We are the most transparent industry in India, and get your reassurance that an isolated event happening at a mutual fund should not impact entire industry.
Mr. Milind Barve, if I can come to you, sir, would you or the industry now seek additional help from the Reserve Bank or the government? Have any representations been made? What kind of help does the industry require?
So actually, just to step back a little bit and just mention to you and your viewers that when people just see the name of a credit risk fund, the normal perception is that the entire portfolio comprises very weak quality paper. Let me tell you that when you, even in a credit risk fund, and many of us in the industry are running a credit risk fund in which cash and AAA is as high as between 20 to 30%. And there's another 50% or so amongst most of the players, which is AA or above AA, which is AA and AA plus. So when you talk of a credit risk fund or a challenge in a credit risk fund, it is really not that the entire fund comprises weak quality paper and high yield paper. So the first thing that people need to understand and look very carefully at fact sheets of different fund houses and get their reassurances that AAA cash holdings and high quality AA and AA plus holdings comprise close to about 55 to 60% of a credit risk fund. So when you say there is a credit risk fund, it doesn't mean 100% is in very weak quality or high yield paper. So and that is set, and as you heard Nilesh, there are no borrowings in this. Most of us are having no outstanding borrowings. We have not borrowed in credit risk funds even in 31st March. This is business as usual. There is nothing to panic. I do believe that the incidents that we are talking about is an isolated incident. It does not reflect on the industry and it does not reflect adequately on the category of the fund, which is the credit risk fund. Having said that, to answer your question about whether more, I think the debt market would obviously require more steps from RBI. I'm sure between RBI and SEBI, they are looking at what proactively what needs to be done further to boost investor confidence. There isn't a liquidity crunch, but there is a need to keep investor confidence high. And sometimes whether it is in the form of line of credit for mutual funds, and sometimes in an extreme case, if you look at central banks globally, what have they done? They've had direct purchase of bonds via central banks themselves, not through the banking systems. So at some stage, it may be necessary for the banks. And as you heard the central bank governor say that he is willing to do conventional and unconventional methods, sometimes it is time to anticipate issues that might come future, which may not be there today, and act accordingly. So I think right now it is business as usual. There isn't any undue liquidity pressure. I do believe that the incidence is a one-off. It is not reflective of the industry's credit quality and liquidity quality at all. But having said that, I think the central bank could do better to have more confidence-building measures in the form of lines of credit, specifically for refinancing mutual fund debentures.
Right. Lata is also with us. Lata, we have the 5 gentlemen from AMFI. Over to you.
Thanks a lot for that, Sumera. You'll have covered much ground. Let me get Ashwini Bhatia in simply because with that link from SBI, probably you have a many-sided dimension. Some of the answers I got from the mutual fund fraternity were that the TLTRO2 itself can be tweaked, and that was a hint which the Reserve Bank gave in the press release when it saw only 50% of the money taken. Would that be the fastest, quickest way to announce it today itself that there are no categories, any NBFC fund can be bought, whatever? What tweaks would you want to the TLTRO? Or do you think that is not enough? What you would need is perhaps a more direct financing line like Mr. Barve has been talking about, so that, for instance, if SBI were to finance, it gets refinancing from RBI. Something on those lines. Since RBI providing credit is something which looks like a distance away, would refinancing be a way out? Ashwini.
Yeah, so before I answer that question, just let me reiterate what Milind and Nilesh have said. So between last night and this morning, nothing has dramatically changed, as far as the market is concerned. Many of us knew that, yes, some of the mutual funds were in some kind of a spot. Now that the cat is out, I think panic will also go away. So let the panic not feed itself. Panic selling, of course, it won't help anybody. Even in the best of times, the markets are illiquid. Even in 2008, when you had the crisis in America, the money markets there broke the buck. Okay, and there they returned less than $1 to their investors. So in times like these, yes, we do face problems. Who would have thought that crude would ever be at a negative price and so on and so forth. But coming back to your TLTRO question, so I think RBI and SEBI are working together. They have done a lot. The fact that the first part, they could raise 1 lakh crores, and it went a long way in helping the AAA paper and the top-rated corporates. Once you come to the lower-rated guys, so you are talking about MFIs, you're talking about NBFCs of between 500 and 5,000 crore size and so on and so forth, there is a certain amount of credit. Now, in normal times, these would have been easily subscribed by investors. In the best of times, like I said, at the cost of repetition, the markets are illiquid. So maybe, just like other central banks are doing, they're buying ABS, they're buying mortgage-backed securities. Bank of Japan is even doing ETFs. So perhaps, given the fact that banks have just come out of a very brutal NPA crisis, who would, want their investment book to have illiquid kind of stock? So what RBI did in 2008, I think, is a pointer. The mere announcement from RBI was kind of enough to give confidence to the mutual fund industry. Once the announcement was made, I think it was back to normal. Nobody really used those lines. So if that confidence is there, I'm sure, we will be much, much better off. I think there was another question also, what really happened? So you've got to be very wary about credit and non-credit at this point of time. What Templeton did, I think, was in the best interests of the customer also. You can't have an arrangement where some people get the exit, some don't. And given the situation, they have taken a particular call to, not announce any NAVs or whatever.
It is not the retail people like me and Sumaira who panic. Actually, we are usually the laziest to move money out. The people who actually move these instruments most are you financial sector participants. I mean, when Yes Bank moratorium happened, I don't think there was a run on the deposits as much as all the other banks and financial institutions shying away from the CDs of private banks. It is not usually the retailer who creates the problem. It is usually financial sector intermediaries who start, risk aversion on a very high scale. So we have to be cognizant of that as well. The retailer, especially in a mutual fund, is usually later to react, if that. Only after it hits the white papers do they react. But that is just an observation from a retail person myself. Bala, your thoughts? The TLTRO gave us one message, that banks are willing to lend, but they're not willing to lend to the tail. So looks like there the government has to step in with a first loss protection or something. Is that called for now?
I think as others mentioned, Lata, I think as you also rightly put it, From the industry point of view, one should not unnecessarily create negative perception on debt funds. Debt funds have seen cycles with interest rate going up and multiple credit cycles. Seen in 2008, had a similar situation coming from one of the small fund, and we came across that quite nicely. And as you also remember, that Reserve Bank of India came with a series of measures immediately after that and ensured that the market not only got calmed down, the rates also came off. With specific to the LTRO, even if you look at the LTRO, since the time it was announced, up to 50,000 crores can be kept aside for the purpose of buying secondary market paper from mutual funds. The total amount that was utilized was only to the extent of about 10,000 crores. That essentially means that 40,000 crores still remains unutilized. And second is, of course, as anybody reacts, the first reaction to buy such securities come from only AAA and PSUs. There is an obvious case for them, for the banks actually go down, and the Reserve Bank of India also encourages banks to go down the credit curve and go up to the investment grade BBB and above, and as long as the companies it's in the certain segment of the market have not gone through a similar pressures in the last 1.5 years of credit cycle, and they remain reasonably good in terms of their loan book, then those kind of names I think should be considered as a part of this limit. The moment that announcement comes, believe me that probably the mutual funds not even use it. That comfort itself will bring back the confidence in the bond market, not only just for the mutual fund, even for the in general bond market, for the borrowers, the rates could come off. And today the issue is about the liquidity that comes at a price. It's not about liquidity is not there. The liquidity comes at a price, especially when an RBI has cut the rate and discourage people to put money in the Reserve Bank of India at above the repo rate. Now it's available at 3.75. As Nilesh mentioned, about 5 lakh crore and odd is going and parking its money at 3.75%. So the obvious case that money actually goes and buys on securities which are below AAA and up to BBB. The moment you start doing it, the Reserve Bank of India encourages the bank to do that, and naturally the bond market confidence will come back. And that's something which, in my view, the Reserve Bank of India should consider, and most of the banks should consider avail this facility from RBI and start supporting that segment of the market, and it will serve both the economy is good as well as for the investors in the bond market also is good.
Right, Nimesh, if I can come to you on this, thanks very much for waiting by patiently. I want to ask about the, credit risk category itself. Given that investors are already jittery, I understand that all of you are seeking to ensure investors to stay put. But what is the future of the category? What is its place in an investor's portfolio? And what would you say to your own investors?
Last 1 year, I have come for your shows or anywhere. I always recommended that credit risk fund is a category that one should be investing in because their credit spreads are good vis-a-vis the risk that we are taking. Today also the credit spreads are good. So I very strongly feel that this today, it's only a 50,000 crore industry today. And this incident will also show who have been the conservative players and who has been the aggressive players. In my mind, it is only 5% of the industry right now. Of the 10 lakh crores plus that are there in debt mutual funds, only 50,000 crores are in credit risk fund. It is a very important category, and this very important thing which Lata mentioned today is that how is your liabilities diversified? We talk about all asset side diversification. Say in a typical credit risk fund, if you've got 80 different credits, right? If you look at our credit risk fund, it has got 80 different credits. So the diversification on the asset side is very important. Another very important point which Lata referred to is the diversification on the liability side. Are your liabilities concentrated with the big guys? Is there institutional liabilities which will run away fast? Or is it liabilities? So when you are assessing a credit risk fund, it is very important to see the texture of the liability side. When people have invested money, have they invested from the lengths and breadths of the country? How would you differentiate? We were talking about what is the difference between the mutual fund that has just announced drastic measures and maybe a lot of people who are there on the panel right now. Liabilities are there from 300 towns of India and all kinds of retail liabilities are there. Then the liabilities tend to be more stable. If you've got concentrated liabilities with major players, then your liabilities will be more. So I think that part is very important. I believe tax adjusted and risk adjusted, debt funds have a very, very important role in a person's portfolio. I know it may not sound the right thing to say, but I believe that this will only grow from here, because this is a very good test today. Today is a very good test when Templeton has announced that after 1 week, we should talk again on this, where how people manage this particular time.
No, I take your point, Nimesh. I take your point entirely that Franklin Templeton has managed this very responsibly, rather than allow the smart guys who got out first to make off with the money, leaving, the less savvy guys holding the can. This orderly liquidation is a very responsible way forward. Certainly helps the industry and helps their own brand name. But Nilesh, now I think we should also discuss a little more on solutions. Is there anything the government can do? See, ultimately, it's a question of companies not being under stress to be able to repay. So, do you think, once again, I'm coming to the question I asked Bala, this first loss protection, do you think an announcement that can come only from the fisc, I would assume? Anything else the fisc can do? And I'll come to you about RBI in a minute. We have already discussed a little of that.
No, Lata, we don't need first loss provision from the fiscal. The credit quality of our portfolio is so superior that there is no need for it. If you remember, in 2008 crisis, there was a run on the bank. The quality of the bank was fantastic. It was just a panic among investors. And the only way that panic was subsided was by keeping operations open, by keeping normal business. We also want to run our business normally.
May I interrupt? I'm sorry. I'm not questioning the credit quality of the instruments mutual funds are holding. At the moment, the question mark is on the NBFC sector itself. And even if there is a question mark on one segment, people run away from the entire segment. There was no business for HDFC bonds and Bajaj Finance bonds to trade at 8% at any point in time. It was not called for when repo was 4.4. But the point is, when there is aversion, it attacks everyone. So why I'm asking you about a first loss requirement is that yesterday's TLTRO results told us something. It told us that banks are not taking that money so cheap because that 25% which they have to put in small NBFCs and 10% in MFIs, they are not very sure they will find the credit. That is the message the banks are giving us from the results. Now, if a first loss was to be reported for, say, MFIs in some small under 500 crore category, the fear goes out and maybe then banks will come ahead and lend. That's why I'm asking you if the message from yesterday's TLTRO was that bankers want some support for the small guy. And if that is not there, they are not even taking any part of the LTRO.
Lata, we need to differentiate two parts. And I respectfully submit that let the market run on its own. We did see a state development loan auction where weighted average cutoff came at 8.18% and tail cutoff come at 8.96%. Now, in that scenario, obviously corporate bond yields and PSU bond yields will go up, but that was for just 1 or 2 days. The same state development loans today are trading below 7.5%. So let's not interfere in the operations of market. It will swing. It's just like equity Sensex. It went to 12,000, it came to 7,600. Today it is trading at 9,100. So let the normal market operations function. Now coming to the broad categories of NBFCs, most mutual funds are invested into higher end of NBFCs, and they did receive money from the first LTRO itself. In the category which you are talking about, microfinance institutions, smaller NBFCs, undoubtedly they were dependent upon bank borrowings rather than capital market borrowings for their funding, and whatever support they require need to be provided like other central banks and other markets have seen. But that support is independent of what is happening at mutual fund level. We don't need any first loss support on our portfolio. The credit quality of our portfolio should give confidence to any investors that his money, her money is safe with us. However, your point is absolutely valid. towards the lower end of the credit curve on NBFC side, on microfinance institution side. We must make all the attempts to ensure that cash flow mismatch does not result into credit crisis in the Indian capital market.
Thanks to all the gentlemen for joining in. I only want to, in summing up this discussion, give the assurance on behalf of AMFI that, the papers that's AA and below account for only 30% of the 55,000 crore rupee industry. The rest of the papers, AMFI assures us, are above board. So mutual fund investors have nothing to worry about. We hope that this is a one-off and that the industry and unit holders can tide over it. Thanks very much for watching.